Japan's debt bomb is not staying in Japan. And if you think it is, you're already looking at this the wrong way. Because Japan didn't just quietly struggle for 30 years. It became one of the biggest cheap money engines in the world. And now that engine is starting to break. Japan's government debt is sitting around 227% of GDP, one of the heaviest debt loads in the developed world. That kind of system only feels stable when borrowing costs stay extremely low. The moment that cushion starts to disappear, the math gets ugly fast. If it breaks cleanly, you probably don't notice. If it breaks badly, it doesn't just hit Japan. It hits US mortgage rates. It hits stock prices. It hits the cost of borrowing across the entire American economy. That's what's actually on the table here. Quick favor before we go deeper. I'm a small new YouTuber, and if you like these straight plain English breakdowns, hit subscribe. It helps YouTube push this to more people who actually want the real story. All right, back to it. Most people hear Japan and mentally check out. Slow growth, too much debt, aging population. Yeah, all true, but that's not the part that matters. The part that matters is what Japan was doing underneath all of that. For years, Japan lived in a completely different financial world. Interest rates were basically zero. Money was cheap, really cheap. And the Bank of Japan pushed that even further, buying massive amounts of government debt, keeping borrowing costs pinned down, and flooding the system with liquidity. At one point, it wasn't even a normal market anymore. The central bank was the market. The Bank of Japan has owned more than half of Japanese government bonds. That's not a healthy market. That's a system where the price of money has been artificially suppressed for years just to keep everything stable. And that matters, because the entire setup depended on those yields staying low. Now think about what that creates. If you can borrow money almost for free in one country and earn more somewhere else, you don't hesitate. You borrow, you move the money, you chase the higher return, over and over again. And here's why that trade got so addictive. If you can fund yourself near zero in yen and buy something in dollars yielding 4 or 5%, that spread starts to feel like free money. Not literally free, but close enough that institutions scale it up. And when enough money chases that trade for long enough, it stops being a side strategy. It becomes part of the system. That's exactly what happened. Cheap money out of Japan didn't just stay in Japan. It flowed into global markets, into US Treasuries, into stocks, into assets that sit underneath the American financial system. That's why Japan mattered way more than it looked like it did. It wasn't just a country with too much debt. It was part of the plumbing. And now the plumbing is under pressure, because the old setup is starting to change. Inflation showed up in Japan, not in a dramatic, panic everywhere way, but enough. Japan's inflation moved to roughly 3%, which may not sound extreme, but in Japan, that's a major break from the old deflationary world. That matters, because it breaks the illusion that Japan can stay in a zero-rate system forever. And once that illusion breaks, the whole system starts to shift, because Japan is sitting on an enormous pile of debt, and that debt only feels manageable when borrowing costs are basically nothing. The moment rates start rising, the math gets ugly fast. Now you've got a real problem. Raise rates too much, and the cost of servicing that debt explodes. Keep rates too low, and inflation and currency pressure keep building. And here's the part people underestimate. The market is already testing this. Japanese bond yields have started moving up enough to force attention again. And when domestic yields become more attractive, Japanese investors have a reason to bring money home instead of sending it abroad. That changes flows. That's the trap. And this is where it stops being a Japan story. Because Japan is one of the largest holders of US government debt. We're talking roughly $1.2 trillion in US Treasuries. So if Japanese institutions decide their own bonds are finally worth buying again, or they're forced to unwind positions and pull money back home, that money has to come from somewhere, and a big chunk of it is sitting in US assets, which means less demand for US Treasuries, or worse, actual selling. And when that happens, yields go up. And once yields start moving, the effects spread faster than most people think. Because government bond yields are not just one part of the system. They are the base layer. They set the tone for everything else. Mortgage rates get built on top of them. Corporate borrowing gets priced off them. Stock valuations get pressured when safe yields rise. Even government interest costs get hit. In other words, the bond market doesn't just react to stress, it transmits it. So when someone says, "Why should I care about Japan's bonds?" That's why. Because if Japan's cheap money era starts reversing hard enough, America feels it. Not as a theory, as tighter money, as more expensive housing, as pressure on markets. And the worst part, you don't need a collapse for this to hurt. Japan doesn't need to implode. You just need enough stress in the system, enough repositioning, enough money moving the other way, and suddenly, everything gets a little tighter, a little more expensive, a little more fragile. Now, to be fair, this doesn't automatically mean disaster. There are a few ways this plays out. The boring version is the best one. Japan adjusts slowly. Rates move carefully. Markets absorb it. No drama. Then there's the messier version. Rates move faster. Positions unwind harder. Markets start reacting. And then there's the worst-case scenario, where the system doesn't just adjust, it snaps. That's not the most likely outcome, but it's not zero either. And that's the point. This isn't some isolated problem. It's a shift in one of the biggest financial anchors in the world. And when something that central starts moving, you don't get to ignore it. Especially not now. The US is already running massive deficits, already dependent on debt markets, already sensitive to even small changes in borrowing costs. So it doesn't take a disaster, it just takes pressure. And Japan is one of the places that pressure can come from. So the real takeaway is simple. Japan's debt bomb is not just about Japan. It's about what happens when one of the world's biggest cheap money engines starts to reverse. For years, that system helped support global markets, including America's. If it unwinds slowly, you still feel it. If it unwinds fast, you really feel it. And that's why this isn't a foreign story anymore. It's a US rate story, a housing story, a market story, and a reminder that when the bond market shifts somewhere important enough, it always finds its way back to you.